Hello everyone, this is Arnaud Delapierre. Today, we're going to look at the incredible story of Enron, this huge American company that caused one of the biggest financial disasters. You've probably heard about how Enron collapsed in record time, ruining thousands of investors in the process. But what really happened? How did an energy giant, driven to the top by enticing promises, end up falling into a monumental scandal? Get comfortable. We will delve into the details of this case that left an indelible mark. Enron, created in 1985 following the merger of Houston Natural Gas and InterNorth, quickly attracted attention with its rapid growth in the energy sector. The company quickly diversified, offering all kinds of services until it became a benchmark for investors. These leaders, Kenneth Lay, then Jeffrey Skilling, built a reputation as visionaries capable of detecting opportunities where others dared not venture. At first glance, Enron seemed unstoppable, as its revenues appeared to climb relentlessly. Yet, behind ultra-positive communication, carefully orchestrated accounting manipulations were accumulating, ready to explode at any moment. Thanks to its rapid expansion strategy, Enron managed to attract a large base of shareholders who were very confident in the company's potential. Enron stock shares were trading at peaks, fueled by triumphant announcements and media coverage. Praiseworthy. In reality, the firm relied on a combination of subsidiaries and ultra-complex accounting practices. The idea was to hide debts in affiliated companies or to artificially inflate revenues. Declared. At the time, few people suspected that Enron was secretly building a house of cards. Investors were swept away by the promise of quick profits without seeing the looming abyss. Before continuing, I have a good tip for everyone who wants to stay ahead in the stock and crypto markets. It's Notrade, available on iOS and Android. This free app is really great. It allows you to create a scoring system on each asset you are interested in. You can set up crypto, stocks of amenities. It will give you a score between 0 and 100, and you will have the possibility, as a result, to position yourself either in buying, staying neutral, or selling, depending on the score between 0 and 100. Go try it. It's free. It's great. Dubious accounting methods. Let's get back to the subject. The very design of Enron's accounting relied on highly questionable arrangements, partly validated by its auditing firm, Arthur Andersen. Enron used this so-called mark-to-market method, recording its anticipated profits on its books as if future gains were already secured. This approach might have seemed clever at the start, as it allowed the reported value of assets to be inflated. However, as soon as the market took another turn, reality caught up with everything. The flattering figures turned into very real losses, but as long as confidence prevailed, no one wanted to admit that Enron's dream was based on a mirage. The internal culture was characterized by extreme competitiveness. The company often encouraged excessive risk-taking with amazing bonuses for those who brought in the most revenue. The in-house analysts were daydreaming about growth prospects, attracting even more investors. Gradually, many departments at Enron began to conceal negative information, fearing the loss of their prodigy reputation. This oppressive atmosphere, combined with limitless ambitions, led some employees to lie openly. The entire system was based on a constant escalation where failure was absolutely not tolerated. Yet, several warning signals began to flash. Financial journalists questioned the legitimacy of certain contracts, and experts tried to understand how Enron was showing staggering profits in a less favorable energy context. The initial doubts turned into suspicions when Sharon Watkins, an Enron employee, reported irregularities in a letter addressed to Kenneth Lay. Instead of a serious investigation, management preferred to downplay the situation and threaten those who wanted to raise the alarm. This atmosphere eventually eroded trust until investors fled. The dramatic turn of events occurred late 2000 or late 2001 When Enron was forced to revise its financial statements, the glorious results actually concealed gigantic losses. The stock plummeted at lightning speed, dropping from around $90 to less than $1 in the blink of an eye. People found themselves without savings because a large part of their retirement plans was invested in Enron stocks. Ordinary shareholders saw their assets go up in smoke overnight. Panic was rampant, and no one knew who was telling the truth in this fiasco, worthy of a bad soap opera. The role of Arthur Andersen. It's important to talk about that too. It's the involvement of Arthur Andersen, then seen as a pillar of global auditing. Its involvement strengthened public confidence, convinced that if such a reputable firm validated accounts, it was a good sign. Unfortunately, Arthur Andersen was too close to Enron and was benefiting from very lucrative contracts with the company. Instead of defending the integrity of the numbers, it turned a blind eye to doubtful practices. When the scandal broke, Arthur Andersen's reputation collapsed like a house of cards as well, leading to its downfall and permanently tarnishing the accounting profession. After the exposure of the frauds, the American government initiated legal action against the leaders of Enron. Jeffrey Silking was found guilty of conspiracy, fraud, and financial crimes. He received a long prison sentence, although he was released after serving part of his sentence. Kenneth Lay, the founder, also had to answer to serious charges, but he died before the court pronounced its final sentence. Several other company executives were implicated, but the Enron affair sparked significant debates on morality in business. The bankruptcy of Enron caused a real shock in the financial landscape, prompting the American legislature to react. The Sarbanes-Oxley Act, adopted in 2002, now imposes strict transparency and increased accountability for executives and audit firms. Listed companies must strengthen their internal control system and accurately justify the reliability of their financial statements. Many saw it as a decisive advancement to counter the loopholes that enabled the Enron scandal. However, this law has not completely eliminated dubious practices in the sector. It has nonetheless highlighted the necessity to restore trust. Behind these major headlines, there are also millions of employees who lost their jobs and savings. Many of them had invested all their resources in their own company's stocks, firmly believing in Enron's success. Overnight, these people found themselves without a safety net, sometimes just a few years from retirement. The testimonies are frankly poignant. Some had to sell their house, others took on a less rewarding job to make ends meet. Beyond the legal aspect, the Enron case remains a bitter lesson for all the people who had trusted. For investors, the Enron case is a reminder of the importance of caution and diversification. When a stock seems to be climbing, when a company claims to generate enormous profits without a clear explanation, it is wise to ask questions. Annual accounts, cash flows, and the strength of balance sheets must be analyzed with an independent perspective. Many professionals also recommend never placing all your savings in a single stock. The Enron case, I think it highlights how essential it is to verify information and remain vigilant, even when the majority seems convinced that everything is fine. Then people will say to me, yes, it's easy to say, an American company, I don't necessarily have the figures, I don't necessarily have the data. How do I do it? It's not easy, I admit it. The Enron shockwave wasn't limited to the company itself. It shook Wall Street and undermined the public's confidence in our financial system. Many large companies reviewed their practices to avoid being accused of accounting manipulation. This case also highlighted the issue of conflicts of interest between audit firms and client companies. We have seen reforms put in place to more clearly separate consulting and auditing roles, even if distrust persists towards some financial groups. The Enron case pushed several players to take the issue of ethics a bit more seriously nevertheless. In conclusion, the story of Enron illustrates how greed and lack of control can cause immense damage. Overnight, thousands of investors lost everything, and this scandal has permanently tarnished the reputation of the financial sector. I hope this overview has shed light on the strings that led to the fall of this giant and encourages you to be more attentive during your own investments. If you enjoyed this video, subscribe to the channel and leave a thumbs up to support the work I do. Thank you for watching this episode. See you soon.